So we were looking at topic number 2, the regulatory framework, So which kind of framework are actually auditors actually called upon to be able to work under? So the regulatory framework. So here we are talking about, for example, the international regulatory framework or the national regulatory framework, as we had actually been able to clearly indicate. We can be able to have what we call the international regulatory framework, or maybe we can be able to have what we call the national regulatory framework. When you talk about international regulatory framework, then we are talking about overall standards that are usually applied in carrying out the audit work, When you talk about the national regulatory framework, then in this case, we simply mean, for example, you are having relevant standards that have been set at the national level, whereby now in this case, we can have, for example, maybe the Companies Act giving guidance as to how you can be able to carry out an audit of companies. So when you talk about the regulatory framework here, we're talking about regulations or guidelines that auditors are supposed to be able to follow in terms of having to be able to carry out their work. They can be set at the international level, maybe at the national level. At the international level, maybe you can have the international standards on auditing. At the national level, we can have relevant statutes or acts of parliament or laws that have been made, in this case, to regulate the profession we call audit work. We call the audit work. So we left at the point where we were just looked at the code of ethics. We had just looked at the code of ethics for professional accountants, professional accountants. So here we said, for example, you as an accountant or professional accountant, you should be able to carry out or actually be able to observe what we call the fundamental principles of the profession, which actually include integrity, objectivity and independence, professional competence and due care, confidentiality, professional behavior. But of course, under independence, we say sometimes there can actually arise what we call threats to independence. So whereby we say that they can basically simply be summarized in an acronym we call SAFIs. We call SAFIs, whereby the first S there simply means self-interest threats. Second S simply indicates advocacy threat. The third F simply indicates it indicates familiarity threat. And of course, I indicates intimidation threat. And of course, S, the last S indicates self-review threat, simply means self-review threat. So those threats can actually basically make you not to be an independent person in having independent profession, in having to carry out your trade or work as an auditor. So you don't have an independent judgment. You're actually influenced maybe by the client himself or those who have an interest in the audit work that is being carried out. They want the report to be able to favor them or to be in their favor. So they can be able to influence you. And of course, it can lead to what we call conflict of interest, or maybe it can actually be able to lead to you not having to be able to give an independent opinion. So remember, I say that for auditors, they are simply professions who are actually called upon to be able to check and review the books of accounts prepared by who? The directors or those who are in charge of governance in the client business operations. And as they carry out this particular review, they should be able to do it independently, and at the end of it all, give an independent report. So in any case, your independence is actually threatened, then you're not actually going to give out a good report or maybe a proper report. So auditors should actually be able to watch out and actually ensure that they are carrying out their profession with what we call independence. Any form of threat arising, then they can actually end up not having to be able to take up the assignment, or maybe they can be able to find ways as to how they can be able to avoid any threat to their independence. So you need to be able to remember those threats that we talked about: self-interest, self-review, advocacy, familiarity, intimidation, threat. So I just want us to be able to look at as to the ways as to how these threats can actually end up having to arise. So we just want us to look as to how, for example, if you are carrying out your work as an audit, how can these threats end up having to arise? You've been given an assignment to carry out an audit. How can they actually end up having to arise? How can they actually end up having to arise? How can these threats end up having to arise? So we can look at the examples as to how these threats normally arises. The threats normally arise. So examples as to how the threats will actually end up having to arise. So you can have number one there, actual or threatened litigation by the client. So whereby there is actually a threat of litigation or having to be taken to a court of law by the client. So this can actually lead to what we call self-interest or intimidation threats. So when we said there are those different kind of threats. So what actually happens, for example, if you are threatened that you are going to maybe be taken to a court of law, or maybe now in this case, you basically end up having to have an accusation of maybe a certain liability. What will actually happen in this case to you as an auditor? You'll basically safeguard your own interests. You will safeguard your own interest and actually compromise on your independence. Or basically in this case, you can actually end up having to just shiver and actually be intimidated and basically bend to what basically the client is actually calling upon you to be able to do. So the firm will be worried about bad publicity, loss of client, being proved negligent. So if you are basically taken to a court of law, there'll be maybe news all over that your firm, Purity LLP is basically battling a court case. So there'll be bad publicity of your firm. You can actually end up having to lose clients. So you'll be threatened in this way, whereby in this case, you'll be intimidated and actually end up having to do what? Compromise on your independence. So when litigation takes place or appears likely between the firm or a member of the audit team and the audit client, then sometimes you can be given gifts or some good kind of hospitality whereby your client takes you out to a big hotel and actually buys you dinner or maybe buys you lunch. So such kind of things can actually basically end up having to threaten your independence. How does it arise? It can end up having to lead to what we call self-interest threats. It will end up making you become so much familiar. So in this case, the client becomes like a family, whereby you're taken out for dinner, you're taken out for lunch as the auditor of that particular client business operations. You are basically given gifts. So you can actually end up having to, for example, now in this case, be intimidated by the fact that in this case, we bought you dinner. We basically bought you maybe this and this. We gave you these particular gifts. We gave you a gift of 20,000. So you cannot actually basically do what is actually contrary to our expectation. So they intimidate you by the fact that they had actually basically helped you in the past. So just being taken out for that particular dinner creates a lot of what we call familiarity. And therefore you'll end up having to do what? Safeguard maybe your own interests. So then there's what we call compensation and evaluation. So a team member is compensated for or evaluated on selling non-assurance services to the audit client. So let's assume, for example, now in this case, you are the auditor of a company XYZ Limited. But of course, now in this case, you also provide other services apart from audit services. Maybe you provide tax consultants. Maybe you actually provide, let's say, for example, maybe due diligence consultancy. Maybe you provide, maybe, let's say, for example, maybe management consultancy. So part of the other services you provide in this case, they could be maybe so many of them whereby you get a lot of revenue out of the other services. So you can actually be threatened in this case that they can be able to threaten you that in this case, if you don't do what we actually expect as your clients in terms of the audit report, then you'll end up having to lose the management consultancy. You'll end up having to lose maybe the due diligence consultancy. You'll end up having to lose maybe in this case, maybe the management accounts preparation consultancy. So that will basically maybe lead you to having to be threatened. And therefore, of course, you'll end up having to safeguard your own interests, whereby you don't want to lose this particular client because of the loss of the revenue due to not providing the other non-assurance. Remember what we learned about non-assurance services. So not only do you provide assurance services like an external audit, you also provide other services. You can be threatened that these particular services will not actually basically be for you as the profession. So due to compensation and actually what evaluation. Then fee dependence, whereby you rely so much on one client to be able to get maybe your revenue. So the client basically provides like maybe 60% of your revenue maybe in a month. So you over rely on this client, so that in this case, in any case, he says that he wants to drop your services because you're not actually basically complying to what he actually wants, you'll actually basically be threatened. So fee dependence can lead to self-interest or maybe intimidation. You'll be intimidated that you'll lose the 60% revenue per month. So you'll actually end up having to do what? Compromise on your independence. Overdue fee. So perceived as a loan to the client, so it can lead to a self-interest or intimidation threat, whereby your fee has been due for long, yet you haven't claimed. It is seen like, for example, you've given a loan to the client. So he threatens you that in this case, he won't pay you that outstanding amount unless you do what he's actually basically expecting. So it can lead to intimidation or self-interest threats. Contingent fees. So contingent fees are fees calculated on a predetermined basis relating to the outcome of a transaction or the result of the services performed by the firm. So you are basically predetermining your fee on what will be the outcome of the audit. So they are expecting you to basically, they have set a mind whereby they are expecting the outcome to be like this. If it is not like that, then of course, now in this case, they tell you you'll only be able to enjoy maybe 60% of your fee, not 100%. So you'll end up having to do what? Bend what is actually basically expected. So that basically leads to what we call self-interest or maybe advocacy threat, whereby you're actually serving as a director or an officer of an audit client. So you are the director of XYZ Limited. In this case, you've been sent out as the lead engagement manager, to carry out an audit assignment for this company XYZ Limited, whereby you actually also are director. So there's already an interest there. You are doing like some kind of like a review of your work, because in this case, you are the one responsible to be able to ensure the books of accounts of XYZ Limited have been prepared. At the same time, you are coming to audit them. So that is a self-review threat or self-interest threat. So you'll always basically safeguard your own interests in this case. So long association of senior personnel, including a partner rotation with an audit client, whereby you are closely associated with a senior officer in the company, in the client business operations, whereby, for example, maybe you've been the partner in charge of the audit for a very long period of time. So you are closely associated with the person. Recent service with an audit client, so it can lead to self-interest or self-review or familiarity threat. Temporary staff assignments, lending of staff by a firm to an audit client may create self-review threat. So sometimes in this case, you might find that the staffs of the audit firm have been sent out to a client business operations, maybe to carry out improvement in the finance department. So they want to basically, for example, set the standard operating procedures. They are basically called upon to set the standard operating procedures for the finance department. So at the same time, also, you did just that just recently. You've also been sent out as the audit firm to carry out an audit for the same finance department. So that is like trying to review what you had actually already set up as an audit firm. So it basically compromises on your independence. No way you are going to question what you implemented in the client business operations. You always basically say it is okay since we are the ones who did what? Implemented it. It leads to what we call what? Self-review threats. Employment with an audit client. So the director or a senior member of the audit client has been a member of the audit team or partner of the firm in the past. So whereby probably you are part of the team members carrying out the audit was actually an employee there. So you are actually an employee at Safaricom just 2 months ago in the finance department, probably in one of the major departments that is carrying out operations. Then you basically got a new job. Let's say, for example, it is an audit firm, maybe one of the biggest, the big four firms. You got a job there and you moved from Safaricom to the big four. At the same time, just after 2 months, you've been sent out on an assignment to carry out an audit for Safaricom as a company. So you'll basically like be reviewing your own work. So there's a self-interest threat, familiarity, and actually also what we call what? Intimidation that can actually be able to arise out of that. Also, we can be able to have what we call family or personal relationships, whereby you are the audit manager, yet the client you are going to carry out an audit on, the director is actually your uncle, is your uncle. So will you carry out the work with an independent mindset? Will you actually question what your uncle does in that particular business operations? You'll end up having, for example, going to be intimidated, whereby your uncle will tell you, I'm the one who actually educated you. there's no way in this case you're going to be able to give out this kind of a report. So you are basically intimidated. There's actually some kind of familiarity. This uncle of yours is like a family. You'll always basically try to do what? Safeguard your own interest in that case. Business relationships. So sometimes it could be maybe you are connected, you have a business relationship as maybe the audit manager with the client business operations, or maybe the director. So this can lead to self-interest, intimidation due to actual perceived pressure about losing the audit assignment. So there can be a commercial relationship whereby, for example, the parties who are involved in the audit are maybe clients, this particular company that is being audited, or maybe there's some kind of common financial interest, like maybe a joint venture with a client. So you have a joint venture with a client whereby you've invested in another company. Maybe it could be 50-50%. Loans and guarantees. So a team member or his immediate family or the firm have actually gotten maybe loans or guarantees from the client business operations, whereby you provide other non-assurance services to the audit client. So like, for example, maybe in this agreed upon procedures, due diligence assignments, management consultants assignments. If you have those other kind of assignments, then sometimes it can always threaten your independence as an external auditor. So firms have traditionally provided to other audit clients a range of non-assurance services. This is basically the practice for audit firms. Not only do they actually provide audit services, they provide other consultancy services, for example, tax matters, for example, management advisory, amongst other services. So they cannot only rely on audit services. They have to provide other services. So that is basically the tradition as to how audit firms are actually able to operate. So apart from just providing the assurance services, external audits, they also provide other range of non-assurance services that are consistent with their skills and actually what? Expertise. And actually what? Expertise. And actually expertise. And expertise. So that is what normally happens with what we are calling threats to independence. That's how they can arise. That's how they can actually end up having to arise. They can actually end up having to arise. They can end up having to arise. So we have the international bodies that are usually responsible for having to do what? Set standards or set frameworks that are actually involved in having to do what? Carry out audit assignments. So the International Regulatory Framework for Audit and Assurance Services. So we have this body we call IFAC, which is actually a global advocacy organization for the accountancy profession, mainly for the financial accounting and audit professions. So it's basically a body that is established internationally to advocate for the interests of the accounting and auditing profession. So it supports development, adoption, and implementation of international standards for accounting, education, ethics, and public sector, as well as audit and assurance. So for example, now in this case, in audit and assurance, in auditing and assurance, the most predominant framework that is there or standard that is usually there, it is the international standards on auditing. Of course, there are others, but that one is the most predominant one that is actually basically most of the time actually relied upon in carrying out audit assignments. When you talk about, for example, accounting, which you've already been taught in, for example, financial reporting or advanced financial reporting. So which, maybe I could be able to ask, which frameworks are there, for example, in accounting? Which frameworks are there internationally to regulate the profession of accountants? Which frameworks are there for accounting, for the accounting framework, or maybe in this case for financial reporting frameworks? So international accounting standards, that's from SAUMO. Apart from international accounting standards, IFRS from Samuel Macau. Apart from IFRS and IAS, international accounting standards, apart from international accounting standards, we have IFRS. Apart from IFRS, which other one? Which other one? Purity, which other one? Which other one is there? Which other one is there apart from IAS and IFRS? Which other one is there? So we have what we call IPSAS. I don't know if you have ever heard of IPSAS. IPSAS. International Public Sector Accounting Standards. So those are basically standards involved in what having to report in the public sector. So those are government entities that are basically utilizing public resources. They have to basically have a framework as to how they're supposed to report as to how they have been able to do what, raise revenue, and they have spent. They need to be accountable. They'll be accountable through which framework? The IPSAS. So this IFAC basically advocates for the development of these frameworks. Those are international accounting standards, which are basically being phased out by currently what we call international financial reporting standards. And of course, you have IPSAS, and of course, you have what we call international standards on auditing. But of course, there are others frameworks in the auditing profession too. So this IFAC basically is normally involved in the education development, ensuring the advocacy of education and actually development of these standards. It also issues guidance to encourage high quality performance by professional accountants in small and medium businesses, accounting practices. So that is the major role of this body we are calling what? IFAC, that we're actually calling IFAC. So this IFAC, this body, then developed or basically formed what we call International Auditing and Assurance Standards Board. So now this board is the one that actually is normally involved in having to set up the framework for the auditing profession. They come up with international standards on auditing. So if there's a new area or new development in the audit world, then they of course come up with a standard or a framework as to how such kind of an area can actually be handled in terms of auditing, how the auditors can be able to approach such kind of an area. So International Auditing and Assurance Standards Board. International Auditing and Assurance Standards Board. So it is normally involved in having to do what? Come up with the relevant standards for the audit profession. So the International Auditing and Assurance Standards Board, IAASB, is an independent standard setting board that develops ISAs. These are basically standards involved in having to regulate the audit work internationally. So IASB issues international standards on auditing covering various services offered by professional accountants worldwide, like auditing, review, and other assurance, quality control, and related services, and by facilitating the convergency of international and national standards. So of course, you are saying that we're having international standards, but of course, I told you also we can be able to have national standards. So as we have that body there, IAASB, having to be involved in having to set international standards, then also at the national level, different countries have been able to come up with their own standards that can actually be able to regulate as to how auditors can be able to carry out their work. So most of the time in this case, you normally find that there is not so much difference between these national standards and ISAs. In any case, we are having both. A country is having the national standards and we are having the international standards on auditing. Let's say, for example, let's assume it's a country like, let's say, for example, maybe USA or maybe Australia. Australia has been able to come up with their own national standards on auditing. But of course, also at the international level, we have the ISAs. What normally prevails first, it is normally the national standards. It's normally the national standards before you can be able to do what? Consider the ISAs. If a country doesn't have, for example, the national standards, then they most obviously rely on ISAs, on international standards in having to carry out the audit work. So this International Auditing and Assurance Standards Board, it has set out a procedure as to how they normally come up with what we are calling standards. So we have the international standard setting process. So we've said in case there's actually a new development, then they have to develop a standard as to how that new development in the audit world can actually basically be done, be handled. So therefore they have to, for example, they'll draft a proposed standard. So what normally happens during the process of having to come up with an international standard on auditing, number one, there's a subcommittee of this particular body is normally asked to write an exposure draft of the new standard when IASB considers that one is required. So they'll be able to make considerations. there's a new development. We need to be able to craft like a new standard handling this particular area in auditing. Then, of course, they'll be able to give this work to that particular committee. They'll be able to draft a proposed standard. That is what you're calling what? An exposure draft. So this particular exposure draft is normally exposed to interested parties. So of course, the interested parties here are usually what? Especially those who are carrying out this profession as auditors across the world. So they'll be able to do what? Be given the exposure draft, look at it, make the assessment. Is it relevant to them? Will it be of so much help to them? Then of course, they can be able to give feedback to this particular subcommittee back. They can be able to give feedback. So that this draft is then exposed to interested parties who comment on the exposure draft. They normally comment on it. Is it making sense? Can it work? So they have to be able to do what? Listen to the considerations of those who are basically in the audit profession worldwide. So the comments are normally reviewed. So you can be able to see the comments that are usually made by those who are reviewing it, or those who have been exposed to it, are usually reviewed now by the board. And the draft is normally amended as required where necessary. If this has already been done and finally it has basically been concluded, then eventually a new standard is normally issued by this particular body. So that is how it normally happens in terms of having to do what? Set out as well. First of all, the body, that particular board, IAASB, will make a consideration as to whether there is actually need for an ESA. Then, of course, they'll be able to ask a relevant subcommittee under that particular board to be able to do what? Draft a proposed standard, an exposure draft. This exposure draft is released out to those who are basically having an interest. And of course, they should be able to do what? Make recommendations as to how maybe it can be improved or what is basically being provided for in that standard. Then eventually those comments are normally reviewed, and then eventually the standard is normally actually issued out. So that is how basically ESAs are normally crafted. So the authority of national and international standards. I've told you we can have national and we can have international. International standards are drafted to be used internationally. But situations may arise where the requirements of international standards clash with the national standards. So sometimes there can be situations whereby there's actually a clash. They're not actually basically conforming or actually in sync with each other. In this situation, there are a number of matters that should be considered. ESAs are not designed to overrule national requirements. So auditors should follow what? National standards or national requirements. However, as ESAs represent international best practice, countries are encouraged by IFAC to change their national practice so that ESAs can be followed. So you're actually at an advantage for you as an auditor to follow ESAs because they are applied globally. Let's assume, for example, you are practicing auditor in Kenya. Then eventually you are transferred, or basically you get a client from where? Maybe Uganda, or maybe Tanzania, or maybe in this case, South Africa. So if you've not actually been practicing ESAs, then you'll have a challenge of having to handle such kind of work of a client. So auditors across the globe are usually encouraged to do what? Use the international standards. But of course, now in this case, if there is so much requirement, then in this case, you can't avoid the national standards because you are saying that in this case, ESAs are not designed to do what? Overall national requirements, because maybe they could be laws that have been set that you must observe as an auditor. So auditors should be able to do what? Follow national requirements. But most countries across the globe, when they are basically coming up with national standards, they'll be able to make a lot of considerations as to what is actually provided for in ESAs. So you might find just a few areas or one or two issues that are not actually basically common. But in this case, they'll always be in sync or maybe common. So we are saying that in this case, this particular body we are calling IFAC encourages those who have already set their national standards to be able to do what? Change them to be like or so similar to what we are calling what? ESAs. If there is no comparable guidance to the ESA in the country, then individual ESA practice can be adapted immediately. So if there is no national standard in any country, they most obviously adapt to what? ESAs, to use them as a guidance as to how they can be able to carry out their audit work. So that is what you need to do to understand about what we are calling what? International standards and national standards as regulatory frameworks for auditors, for auditors. So we are saying IAAS was established by IFAC. The members of IAAS are usually appointed by IFAC board to serve on the IAASB. So this is International Auditing and Assurance Standards Board. So IAASB. So IAASB members act in the common interest of the public at large and the worldwide accountancy profession. So they basically take into consideration all the interests of the profession we call accountants, or those professionals we call accountants across the globe. They are serving the international professions, international community. So therefore, now in this case, they have to make considerations across the globe when they are basically, for example, carrying out their work. So they need to be able to do a lot of research as to what is actually basically happening, for example, in Africa, in terms of the audit profession, what is happening, for example, now in this case, for example, in the US, in Europe, in terms of the audit profession, so that in this case, when they come up with standards, they are so much relevant across the globe, across the globe. So there are other standards. Of course, I have told you the most predominant one that basically regulates the audit profession, it is ISAs. So IAAS issues a number of other international standards in addition to ISAs. So we don't only have ISAs, but they also basically craft other standards. But the most common ones that you'll hear when people are talking about auditing, there are these ISAs, but of course there are others that handle other issues concerning audit. For example, apart from ISAs, this particular body is actually able to develop what we call international standards on review engagements. For example, if you are carrying out a review engagement, how do you go about it? They have already also been able to do what? Set up such kind of standards. International standards on assurance engagement. So they have also ISAES. So in assurance engagements, other than audits or reviews of historical financial information, that is where they actually applied. Review engagements, standards on review engagements are usually applied what? Applied where? In review of historical financial information. While ISAs are basically applied in the audit of historical financial information. Audit of historical financial information. Then you have international standards on related services. So on, if, for example, if you have a compilation engagement, so other non-assurance services, how do you go about them? So they've also been able to set up those standards. Then international standards on quality control. So how do you basically deploy quality? So they have also set up standards as to how you can ensure quality in your work. So the current ISAs we have, they have been listed here. There are so many of them. So like, for example, these are just examples that we have here that have been listed. We have so many of them that have been listed here. All the ISAs have been listed here that we have currently. So like ISA number 200 talks about overall objectives of the independent auditor. ISA number 210, agreeing the terms of audit engagements. If you want to know more about the terms of engagement of an audit, you look at that particular standard. You can always be able to get it online. If you want to know more about audit documentation, for example, working papers and all those ones, you look at ISA number 230. ISA number 240, the auditor's responsibility relating to fraud in an audit of financial statements. ISA number 250, consideration of laws and regulations in an audit of financial statements. So how do you consider the relevant laws and regulations? Then ISA number 260, communication with those who are charged with the governance. So how do you, for example, approach the directors in terms of having to be able to, for example, seek for any relevant information that can be used as evidence? How do you communicate to them? How do you communicate to them? So communicating deficiencies in internal control systems, how do you do it? ISA number 265 addresses that. We have ISA number 300, planning and audit of financial statements. Number 315, identifying and assessing risks of material misstatements in your audit work. You can look at that standard. It will guide you as an auditor. ISA number 320, materiality in planning and performing an audit. How do you check out on the levels of materiality or importance of the audit evidence you are gathering? 320 will guide you. Auditors' responses to assess the risks. How do you respond? ISA number 330. 4.2, considerations relating to an entity using service organization. 450, evaluation of misstatements identified during the audit. Audit evidence. How do you approach audit evidence? How do you gather audit evidence? how do you approach audit evidence? 501, audit evidence, specific considerations for selected items. We have external confirmations. External confirmations is we have ISA number 510, initial audit engagements. ISA number 520, analytical procedures. 530, audit sampling. 540, audit of accounting estimates. 560, subsequent events, going concern, written representations. So they address each and every area of the audit work. So if you want to just know more about, for example, written representations, you search out for ISA number 580. Written representations are basically sought from those who are charged with governance. You communicate to them that you want written representations concerning those matters that they can only be able to give out that particular information. You seek for written representations from those who are charged with governance, which can be used as evidence. If you want to address going concern issues, for example, the existence of the client business operations for the foreseeable future, you want to check out on that as to how you can be able to approach it and carry out an audit on going concern, you look at ISA number 570 like that. So they actually address each and every area of the audit work. And in any case, there's actually a deficiency. That's when we are saying that in this case, this particular body you are calling IAASB now has to find a way as to how they can be able to do what? Come up with now a new standard. So you can be able to go through them one by one. But as of course we go on with the auditing and assurance here, we'll be touching on some of those particular areas or standards that are relevant to what we are going to study in each and every topic. So we can look at what we call the auditor's professional liability and legal responsibilities. Auditor's professional liability and legal responsibilities. So when you are called out as an auditor, you have a responsibility. There are those who are actually interested in this work you are carrying out. Because for auditors, for example, if it is actually an auditor of a company, you will actually be appointed by who? By the shareholders of the company. Maybe it normally happens at the AGM. So you've been appointed, they have an interest in the work you're going to carry out. Not only shareholders normally have an interest in the work of the auditor, we have other interested third parties, let's say, for example, maybe investors, lenders, who are going to rely on your work as an auditor on your audit report to make informed decisions about the client business operations. So you as an auditor, you have a responsibility. In this case, to be able to do what? Carry out your work, considering your knowledge, capacity, and actually experience, and actually deliver or give out an appropriate report. Because in this case, if you end up having to give out a report that is not actually correct or inaccurate, you would have failed on your professional responsibility. You can end up having to be accused to be negligent. Those who are basically relying on your work can accuse you of what we call negligence. So accountants who do not discharge their services responsibly will face what we call legal liabilities. You can end up having to be taken to a court of law. You can be called upon to pay for damages or maybe losses incurred as a result of having any party having relied on your work as an auditor. So those professional code of ethics, or basically professional principles that are supposed to be observed by a professional accountant, they should be observed to the latter. They should be observed to the latter. Integrity, all those ones. Independence, all those ones. Because in this case, they can end up having to make you become what? Liable. So you must discharge your services responsibly. Because in this case, you can actually end up having to do what? Face legal liability. So how can an auditor be liable? He can be criminally liable, or he can be liable under specific statutes, or he can be end up having to become liable under what we call civil liability or negligence. You have criminal liability, and we're going to see how criminal liability actually normally arises. There could be specific statutes or laws that call upon an auditor to be able to, for example, follow the required regulations under that law. If he compromises or basically fails to observe those particular requirements, then he can be held liable, can be held responsible under what we call what civil liability. So how does criminal liability actually arise? How does it actually arise? Whereby, for example, number one, where there's actually breach of trust. Breach of trust. So the auditor not maintaining the confidentiality of the information or not using client information for the benefit of the client. So whereby in this case, you basically leak out information concerning the client. So in this case, if this is the case, then you would have actually failed on your professional ethics requirement, or under what we call confidentiality. If your client discovers this, then he can hold you responsible under criminal law as having to be responsible criminally liable. So they have used an example there. So Right Accountants are the auditors of Divine PLC. Divine PLC has recently tendered for a catering contract with Ket Airlines. The partner of Right informed his brother-in-law, who was a caterer, about the value of the tender. This is a criminal liability involving a breach of trust, since this information is actually leaked out. You know information about your client, about what the amount of the tender, yet you leak it out. So this is a criminal liability involving breach of trust, since confidentiality is not maintained, i.e. information about the client was passed to the auditor's brother-in-law. Client information was not used for the benefit of the client, i.e. it was used for the benefit of the auditor's brother-in-law. So there is actually a breach of trust. So in such a case, if the client discovers, he can hold you responsible under what we call what criminal liability. Then, for example, if there's actually what we call what breach of contract, a continuation of an audit engagement after the term of appointment is completed. So whereby now in this case, you basically breach the terms of the contract under which you actually agreed with your client. So in this case, it can actually end up having to lead to what you are calling criminal liability, because you're not actually basically fulfilling the requirements under the agreement of the contract. And then you can have what we call insider trading. The auditor makes use of unpublished price-sensitive information to obtain personal benefits. Auditors generally avoid purchasing shares in client companies so that the probability of insider trading will not occur. What we mean by insider trading here, sometimes you could be having information internally about a company that has not actually yet become public. Then you actually end up having to do what? Take advantage of this information. For example, this vice we call insider trading in Kenya, it is normally regulated under what we call the Capital Market Authority Act. So this Capital Market Authority Act of Kenya basically prohibits what we call insider dealing or insider trading, whereby, for example, if you're actually an insider in a company, you take advantage of the inside information and either buy more of the shares of the company or maybe sell more of the shares of the company. Let's assume, for example, now in this case, if our friend here, Purity, is actually, let's say, an employee, or maybe let's say, for example, maybe a director at Safaricom. So Purity is actually privy to the information that in this case, Ndegwa is actually going to be fired as the MD in the next 1 week. Ndegwa is going to be fired as the MD in the next 1 week. He has that information. This information has not actually yet become public. Remember, in this case, Purity is actually what? A shareholder there at Safaricom. So what Purity can actually be able to do in this case, since he already has the information, he can sell all her shares because he knows once this information is actually released out there, the prices of Safaricom, of the shares of Safaricom will drop. They can end up having to drop by 2 or maybe 3 bob. Because that will basically be an abrupt announcement, unexpected announcement. Safaricom is doing so well under Ndegwa. How comes? In this case, they have actually ended up having to do what? Fire this person. If you look at the prices of this particular company, if it's a listed company, then you'll end up having to realize that the prices have dropped. For example, if you checked on the stock exchange yesterday, that the prices, let's assume it is maybe today. You check the prices today, for Safaricom shares, it is actually at maybe 17 shillings. Then tonight, maybe tonight at around 9 p.m., they make the announcement, or there's actually breaking news that Peter Ndegwa is no longer the MD at Safaricom. Mind you, if you check the prices of Safaricom tomorrow, on the stock exchange, they would have dropped probably by maybe a shilling, maybe 50 cents. They would have gone maybe up to 16.5 or maybe 16 shillings. So this is what you are saying, that in this case, Purity was actually privy to that particular announcement that was supposed to be made today, a week ago. So what she did in this case, she simply did what? Sold all her shares in Safaricom. So that is, if she does that, then we say she has been involved in what we are calling what insider trading, taking advantage of inside information to trade in the shares of the company that is yet to become public. That is yet to become public. So if you're involved in such, then we call it what insider trading. So since auditors are actually experts who deal with companies or maybe client business operations, they can be able to know more about them. If it is not performing so well, they'll be able to know. It is a struggling company, they'll be able to know. So if there are shareholders there, then they can actually end up maybe to sell the shares. If it is doing so well, then they can end up having to do what? Maybe buy more shares, because they know the company is going to have a serious investor in the next 1 week. So the auditors, what do? They buy more shares because they are going to benefit. Because this investor is going to come in and actually ensure the company has been able to do what? Strike oil into Turkana. Oil is actually very valuable for a company to be able to have as a product. The shares of this company are likely to do what? Go up. So what do they do as auditors? They buy more shares. They buy more shares. This one is normally prohibited because it has led to an instability of several companies, whereby if you have a predominant shareholder who knows that in this case, the company is not doing so well and is actually an insider like a director, he normally ends up having to sell all his shares. And of course, his injection in terms of capital is normally lost. And the companies will likely end up having to do what? To dwindle like that. And of course, they become unstable. So it has been regulated, for example, in Kenya by the Capital Market Authority Act. So there's rumor in the air, or there used to be rumor in the air, that in this case, this is like what actually happened to Uchumi. So there was actually a very serious investor at Uchumi, but this person or guy actually ended up having to do what? Sell all his shares. Sell all his shares. So he's one of the major investors that you know. Of course, he's not still alive, but he ended up having to do what? Sell all his shares at Uchumi. After he did that, Uchumi became very unstable. It ended up having to do what? Liquidated like that. So this basically has led to instability of companies, and that's why it is normally prohibited. In any case, you are found out, for example, to be involved in insider dealing, then you can actually basically be penalized or actually be fined hefty fines. So that is not something that for you as an auditor you'd like to go through. So you need to be able to avoid what you are calling what's insider dealing. So you're saying insider trading, the auditor makes use of unpublished, price-sensitive information. The announcement that Ndegwa is going to be fired, you make you take advantage of that to obtain what? Personal benefit. What is the personal benefit? You sell off the shares while they are still actually at a good price. Auditors generally avoid purchasing shares in the client company so that the probability of insider trading having to occur may not arise at all. Whereby, for example, in this case, for you as an auditor, you fail to report what we call fraud or money laundering. We are going just to look at, I think it is in the next topic, probably the money laundering or the next topic. We'll be able to look at the responsibility you have as an auditor in terms of what we are calling what? Money laundering. Money laundering. Money laundering is whereby, for example, in this case, someone who has acquired money illegally tries to clean it through different systems of banking. So the money seems to be very clean. Maybe the money was gotten from drug trafficking, or the money was gotten from corruption in government. So he basically injects it in the financial system. He moves it to maybe a US account. He sends the money to the relative there. The relative probably maybe does this and this. Or maybe it could be he basically acquires valuable products like maybe jewelry. Then he comes and actually sells it. It is basically presumed that, like in this case, he's getting the money genuinely. Yet initially from the initial source, the money was not actually basically gotten in the rightful way. It was from corruption, embezzlement of public funds. Then he tried to clean it by maybe buying properties like plots and lands and started selling them. So that is money laundering. So in this case, for you as an auditor, you have a responsibility. And of course, at the engagement stage or at the planning stage, you have to be able to do what? Do your evaluation and actually understand your client properly. which kind of business does he actually carry out? That's why for big established firms, they likely end up having to set up what we call a money laundering department. They will have, for example, now in this case, a money laundering officer who's actually able to evaluate from time to time the client that this particular audit firm actually deals with. In case of any hint of money laundering, then of course he has to be able to alert, for example, the partners or the managers or the top management of the audit firm as to how they can be able to approach such kind of a client. So you have to report any form of fraud or money laundering. You have a responsibility as an auditor. And in this case, maybe you can end up having to establish or basically appoint a money laundering officer in your audit firm, just to be evaluating and screening your clients to check for any chances of what you are calling money laundering. So if you fail to do report this, then you can actually also be held criminally liable. Maybe you can be presumed you colluded with your client to be involved in what you are calling money laundering. So that also can be able to lead to what you are calling criminal liability. Willful false statements, whereby you willfully participate in actually having to issue out false statements about the client. Then destroying or damaging any documents that are so much relevant or important as maybe part of the evidence required in having to provide the audit report. So that is also a situation whereby you can also be held criminally liable. So we can take a small break so that in this case we can be able to come and see if we can be able to wind up with the other areas. Yes, welcome back. Yes, welcome back. And I hope we are together. Are we together? Are we together? Are we together? Are we together there? Are we together? Welcome back. Are we together? Samuel Macau, are we together? Samuel Macau, are we together? And Samuel Macau says yes. I don't know what about the others. You know, others could have taken a break to go and take supper. I don't know if we are together. Purity, are we together? Purity, are we together? I see Beacon Solomon says yes, we are together. Beacon Solomon says yes, we are together. Sue says yes. Sue says yes. Tuko pamoja. It seems Purity has gone to take supper because she's not responding. So we can continue. So we have specific statutory liability. So these are basically liabilities I'm telling you they'll be able to arise from a specific statute law. They are basically specified by a specific law, maybe regulating a certain area of audit work. So what do you mean by a statute? Is simply a law that is actually made through Parliament. So you have different kind of acts. We can have the Companies Act, we can have the Accountants Act, we can have receivership, and we can be able to have what we call Company Administration Act, Administration and Liquidation Act, the Receivership and Administration Act. We can be able to have what we are calling Capital Market Authority Act. They are simply basically laws that are usually made through Parliament to regulate a certain area or a certain matter of concern. So we call them statutes, laws. So in any case, there's a specific statute touching on your work as an auditor. Then you do something that is actually contrary to that particular statute. Then you would have basically breached on the statutory requirements, and therefore that particular statute will actually hold you liable. For example, it could be a liability arising from insolvency legislation. So, for example, here we have the insolvency. I don't know which one, which particular specific act it normally is for. So, you normally have, for example, the Insolvency and Administration Act. That one basically gives guidance as to how, in this case, for example, a company life can actually end up having to come to an end. So, in this case, you as an auditor, you do something that is actually contrary, that is actually specified out in that particular act. Then you can actually be held to account. So there could be a liability arising, for example, from an insolvency legislation or act. Insolvency legislation or act, for example, what I'm telling you about Kenya. We have the Insolvency and Administration of Companies Act. How insolvency of a company can actually be carried out. So insolvency simply means company imesota, and therefore it has to be able to do what? Handle its issues of having to ensure it has been able to pay out, for example, all liabilities to creditors. So if an auditor does something that is actually contrary or approves something that is actually contrary to what is actually provided for under such kind of a statute law involving insolvency, then he can be held responsible under that specific statute. Therefore, he can be held under what we call statutory liability. And then we have liability arising from statutes such as a tax legislation. You know what I mean by tax legislation? For example, we have you can have the Income Tax Act. Which other act do you think is there concerning matters involving tax? Which other acts do you think is there concerning matters involving tax? I've given you one. For example, the Income Tax Act. Which other act do you think is there concerning matters involving tax? You should be able to mention to me this one. Which other act do you think is there that is actually concerning matters to do with tax? You have the Income Tax Act. This one you've learned about it in, because there are those who are doing maybe advanced tax, those who are not doing, but of course you should have had a clue. Like, for example, in public finance and taxation, if you've done it, if you've studied it, you could be having an idea. Like right now, when you're having the finance bill, they are predominantly talking about certain issues. concerning taxation. So you must have heard, for example, they could mention the Income Tax Act, so like that. So apart from the Income Tax Act, which other one? Value added. Very good, very good. That is very brilliant. Very good. Value added tax, VAT. Apart from VAT, apart from VAT, apart from VAT, apart from VAT, which other one? You can have the Customs and the Excise Acts. So those are the major areas that's where government basically gets their revenue in terms of tax. So you have the Income Tax Act, which basically involves that individual taxation, whereby you are actually employed there, but of course they deduct you, they remit. It is under income tax. You have, for example, corporate tax at 30%. That is under income tax. So corporate tax is basically under Income Tax Act. It is an income of the company that is actually taxed. So the provisions or regulations as to how this is supposed to be carried out, it is normally under the Income Tax Act. That is the income of the company being taxed. The individual income is actually also being taxed. It is under the Income Tax Act. We have VAT, you know, because you know VAT. Value added tax. So you can have vatable goods, non-vatable goods. So right now they have said what? There's something that I've said about VAT, which you should have had. They're going to basically review VAT for fuel. From which percent? 80%. 8%. It used to be 8% since COVID. I think they are going to bring it back to 16%. 16%. So VAT is there. We have customs and excess. Customs are about matters of having to import goods to come in, So you buy a car, like right now, Purity has bought a car from Japan. So she's expecting it to land or arrive or dock through the ship at the port of Mombasa next week. Next week, a Mercedes-Benz. So this Mercedes-Benz for Purity is actually going to be taxed before it can basically be released from the port. So that's where the customs and excise tax actually comes in. So those are basically statutes or laws that were actually made by Parliament regulating as to how you can be able to handle matters to do with tax. And of course, you as an auditor, there's no way you'd miss out having to be involved in matters concerning tax. So therefore, if you're actually involved in anything that is actually contrary to the provisions of those particular acts we are talking about, then you'll actually be held liable. So liability arising from statutes such as tax legislation, like the Income Tax Act, like the VAT Act, like that. So for example, when the auditor does not disclose creative accounting practices made by the client with the intention of paying lower taxes. So instead of having to basically, for example, declare the expenses as they are, you collude with your client to do what? Declare more expenses, so that in this case, the income can be so much low, so that the corporate tax reduces. If there's such kind of a collusion. Liability arising under regulatory legislation. So for example, non-compliance with the stock exchange regulations. Stock exchange regulations, for example, the CMA Act. Criminal offenses, if proved, are punishable by payment of a penalty and or imprisonment. So for criminal offenses, like these ones that we talked about here, you can be penalized. For example, what I was saying, insider dealing, you can be penalized or be fined. A hefty fine by the court, or you can be imprisoned. You can be imprisoned. Then you have civil liability. Civil liability is whereby, for example, now in this case, you carry out your trade or profession as an auditor with what we call negligence. Negligence simply means you fail on your duty of care. So you have a duty of care to ensure you carried out your work as per the professional principles requirements or as per the code of ethics requirements. But you end up not having to be able to do so. As a result of this, you do a shoddy job. Out of the shoddy job, your client or maybe the third party is relying on your work, they end up having to suffer. For example, you're supposed to be able to, in this case, deploy the knowledge and your capability in terms of experience to be able to deliver on your assignment. That is part of the requirements under the code of ethics. but you've ended up not even having to apply your knowledge you've acquired to carry out the audit assignment. You are acting negligently, a don't care attitude. You don't care. So even if you have forgotten something about a particular area, you can't even make a reference from your fellow profession or maybe from your seniors to be able to understand as to how you can be able to approach such kind of work. If you do such, then you are acting negligently. You don't even care. You failed on your duty of care. You don't actually put in mind the concern of those who are going to rely on your work. So in this case, you just do the job as you wish. You've basically acted negligent. In that case, you can be held liable under what we call civil liability. So a professional accountant can face civil liabilities for negligence when he conducts his duties negligently. And of course, in this case, we normally say negligence is one of the torts that can actually be committed by a party against another party. For negligence to be proved, for example, before a court of law, then there are usually 3 key elements to be proved, as I've already emphasized. The element number 1, you as a professional accountant, you had a duty of care. Number 2, what happened about your duty of care? You failed on it. Out of having failed on it, there's another third party who relied maybe on your work, or basically who depended on you. And of course, he ended up having to suffer a loss or a damage. Because in this case, if you as an auditor, you have a duty to ensure you carry out your work as per the requirements under the Professional Code of Ethics, and you fail on it, you have that duty, but you fail on it, then someone like an investor or a lender relies on your work, yet that work you've done, you've not actually done as per the requirements. You acted negligently. Then he ends up having to suffer a loss or a damage. How does the loss or damage actually arise? Maybe as you portray in your accounts, audited accounts, that the company is actually okay. There are no issues. You as investors, you can rely on my audit report, make an informed decision, and buy shares. So they end up having to rely on your report, saying that everything is actually okay. There is no chance of form of any fraud that is happening in the company. The company is very stable. To give them the confidence, they end up having to do what? Invest. Once they just put in their money like this, next week or maybe after a month, the company is going to be liquidated. It cannot be able to meet its obligations. It is actually declared to be insolvent. In this case, your audit report basically misled the investors or maybe lenders of money to the client that you're actually auditing. So they ended up suffering a loss. What is the loss? They were not actually able to, for example, now in this case, recover the money they invested in this particular client you're actually auditing. They have suffered a loss. That is a damage. You have a civil liability, in this case, to be able to be answerable to. So they can be able to say, for example, now in this case, you do the compensation for all the losses that are basically incurred by those who relied on your report to do what? The investment or to lend the money. So that is how basically negligence can actually end up having to arise. Can actually end up having to arise. So there's what we call liability for negligence, whereby in this case it can lead to what we call civil liability. Civil liability. Civil liability. So how does it arise? So an act of default means either an act or omission which occurs due to non-application of the professional care and skills which are normally applied by accountants and auditors. So that's what I'm saying, that you already know that you as an auditor, there's a way you're supposed to carry out yourself. You've already been given the professional ethics, code of ethics, you have them, but you don't follow them. You don't follow them. In that case, you're acting negligently. It can lead to what you are calling civil liability, whereby the repercussions, you can be called upon, maybe it is actually in a court of law. You pay for the damages suffered by the other parties or third parties. So the key thing here we are saying it is that it must lead to what you are calling a financial loss. So that financial loss should actually basically be there, because you are saying for a proof of negligence in a court of law, those 3 key elements must be there. If one of them is actually missing, then the third party cannot actually be able to accuse the auditor for negligence. For negligence to be proved in a court of law against the auditor, then the third parties we are calling lenders or investors, you should be able to prove those particular key elements about the wrong. If these particular elements are there, then negligence can actually basically be accused on the auditor, and therefore civil liability will actually arise. Number 1, duty of care by the auditor. Number 2, he failed on the duty of care. Number 3, they suffered a loss. So they have to be able to, for example, quantify how much loss they have suffered as a result of having to rely on the work of the auditor. If they can be able to prove these three, then in this case, negligence can actually be proved against the auditor, and civil liability will actually what? Arise. Would actually arise. So as you're saying, generally in this case, the auditor has a duty of care to who? To the client or third parties, the ones we are mentioning, like investors or maybe lenders of money. So this is what I'm trying to emphasize. An act of negligence arises when a duty of care exists. For a duty of care to exist, the following factors need to be satisfied. The accountant must be in a position to reasonably foresee that the statements or the work carried out by the accountant would be relied upon by the client or a third party. The accountant is sometimes informed before carrying out the work that a third party would rely on the statements. He already knows this work is going to be relied upon, but he does not actually basically take a duty of care in carrying out his work. If that is the case, and in any case it happens that in this case there's actually a loss that has actually happened, then it simply means that the auditor can actually be accused of what we are calling what negligence, which can lead to what we are calling what civil liability. Professional accountants can be charged with liabilities for negligence only if either their clients or third parties suffer from financial loss. That's why we are saying this element number 3 must actually always be present. That the work that was relied upon done by the auditor led to a financial loss on account of the acts of the auditor. As a result of his negligence, it is as a result of this that we actually ended up having to do what? Suffer the financial loss. So there must be a financial loss. So that in this case, if the matter is there in the court, I can ask the auditor to pay for all the losses, to pay for all the losses. So that's how you can be able to prove what? Negligence against the auditor. You can prove negligence against the auditor. So you've said there are how many kind of liabilities? You can have criminal liability, you can have statutory liability, you can be able to have what we call civil liability against the auditor. The auditor should actually always safeguard himself from these liabilities having to arise. From these liabilities having to do what? To arise. So for you as an auditor, how do you safeguard yourself? Because you're saying, in any case, these liabilities are likely to arise. So you need to go into the assignment as an auditor knowing I can be taken to a court of law if I don't carry out my work very carefully. So as you carry out your work, you need to be very careful as an auditor. So how do you avoid this kind of liabilities having to arise? Restricting audit liability. How do you ensure that in this case, for example, you avoid the liability or maybe reduce on it? You can sometimes avoid it completely or maybe just reduce on it or put in safeguard measures. If they basically arise without you having expected them, how do you go about it? They can arise, for example, in this case, you put in all the measures, but eventually they end up having to arise due to a small mistake or something actually happened as part of maybe your team members let you down. What will you be able to do as an audit firm? So how can you be able to avoid completely? Reduce on it? How do you go about it when it has actually arisen? So there are several ways as to how you can be able to approach this. So how do you restrict this audit liability? All audit firms want to avoid litigation due to the bad publicity that is likely to follow. The financial consequences and the potential collapse of the audit firm. There are several ways that an audit firm can reduce its exposure to claims. So number one, you need to observe your client acceptance procedures. So firms should carefully assess the risk associated with potential audit clients. Screening procedures should be used to identify matters that create potential exposure for the audit firm. For example, it would be unwise to take on a new client with significant going concern problems. So at the client acceptance level, before you take up the assignment, you need to be able to do a lot of screening and actually understand your client. If they are going concern problems, don't accept to take up the assignment very fast, because in this case, you could carry out the audit, yet in this case, those who are basically going to do what, rely on a report, indicate maybe you didn't actually highlight out that indeed the client is no longer going to be in existence. Then performance and documentation of your, always ensure you document your work. All the audit evidence relied upon to form an opinion, document it. Document it. So that in this case, you can be able to protect yourself or actually safeguard yourself in a court of law. When things have gone marambas, if you have the audit evidence you relied upon, you can present as evidence when you are being accused of the liability. So performance and documentation of the audit work. Ensure you perform the audit work to the latter and document it, because it can be a savior if the liability actually arises. It can be part of the evidence you can be able to present to safeguard yourself from a liability. So performance and documentation of the audit work is actually of so much importance for you as an auditor. Quality control. Ensure there is quality in your work. Quality in your work. How do you ensure quality? For example, you ensure you deploy competent staffs or part of the team, as part of your team members in carrying out the audit assignment. Persons who are qualified and actually understand how to carry out such kind of an assignment. So that in this case, at the end of it all, you'll be able to present the correct audit report that can be relied upon by the client himself and even third parties. Because in this case, for example, if you deploy someone you've just employed yesterday to be part of the team members carrying out an audit of Safaricom as a company, how do you ensure that there's actually quality? There won't be quality there because part of the team is not actually basically fully qualified to carry out an audit on a client like Safaricom, which is actually a very big company. Ensure quality control in your work as an auditor. I've just mentioned one way as to how you can ensure quality control. Ensure you deploy competent team members or part of your team in carrying out your audit assignments. External consultations. You can't be an expert in each and every field. You need to be able to do what you consult where necessary. Consult where necessary. Firms should make use of external experts when the need arises. For example, obtaining legal advice where appropriate to ensure that auditors' actions are acceptable with a legal and regulatory framework. You can always consult in the areas you don't actually understand. For those who understand the statutory provisions, they'll guide you. For example, you don't understand something about the VAT Act. You look for an expert in matters to do with VAT to be able to advise you. Issue a disclaimer. You can issue a disclaimer in the engagement letter. In recent years, it has become common in some jurisdictions for audit firms to include a disclaimer paragraph in the audit report. This is an attempt to restrict the duty of care of the audit firm to the shareholders of the company, thereby attempting to restrict legal liability to that class of shareholders. Disclaimers, however, may not always be effective. You put a disclaimer that, of course, the persons I'm expecting to rely on this report are only shareholders. This report is not of so much importance to who? To third parties like lenders. Don't rely on it. So you put an earlier disclaimer to avoid, for example, a civil liability having to arise. So you can issue a disclaimer in the audit report. Use an engagement letter. The engagement letter should be used to clearly state the responsibilities of you as an auditor. But in this case, you clearly indicate in the engagement letter, part of the content that we already saw. I think we looked at engagement letter in the first topic. We said in the engagement letter, for example, you could be able to, there's normally the indication as to what is the responsibility of the auditor. Clearly indicate in the engagement letter, it is my responsibility as an auditor to be able just to review and check as to whether the books of accounts have been presented as per the requirements of the relevant standards, and they actually reflect a true and fair view about the client affairs. It is not my responsibility as an auditor to do what? To prepare the books of accounts. The books of accounts have been prepared by who? Those who have been charged with governance, the directors. So unajitoa kwa ngori, unaruka mapema. So in this case, if you are talking about how the books were prepared, don't question me as an auditor. Question who? Those who are charged with the governance. Clearly outline your responsibility in the engagement letter, so that if someone wants to be able to accuse you, he might clearly know that there's no way you can accuse an auditor for this particular matter at hand. Capping or setting a limit on the amount of liability. For example, in this case, before you take up the assignment, you can be able to cap the limit to the liability you can be able to bear as an auditor. You can say, for example, in this case, I'm carrying out this audit assignment, but in any case, there's a liability arising beyond 1 million. I won't bear it as an auditor. If there are liability arising beyond 1 million, I won't bear it as an auditor. So that in this case, the client himself clearly knows this auditor is taking up the assignment, but he's already done a cap on the liability arising. In any case, a liability arises, this auditor is accused in a court of law, is called upon to pay a penalty or a fine of 2 million. He won't bear the extra million. He will only be able to bear what? Only 1 million. So he's actually able to reduce on the liability by capping or setting a limit on the amount of liability. The amount of liability. Then operating as an incorporation. So if you operate as an incorporation, for example, in this case, it simply means that the corporation itself will actually be responsible for the liabilities arising, not you as an individual auditor. So operating as a corporation. So the firm will basically be able to bear the liability by itself, not the auditor himself as an employee of the audit firm. Then the last one, choosing to operate as a limited liability partnership. By a limited liability partnership is whereby, for example, if you have 10 partners, the partner who was responsible in that assignment is the one who will be accountable, not all the partners. So the liability is basically limited to a specific partner who was responsible for the audit assignment. We could be having maybe 3 partners who have formed a limited liability partnership. One of the partners is basically engaged in the assignment to carry out an audit on Safaricom. A liability arises out of that assignment on the specific client Safaricom. That specific audit partner is the one who will be able to bear the liability, not the other 2. So there's a limitation in terms of your liability as a partner. You can't bear the liabilities of other partners. You just bear your own liabilities. In this case, if it happens, then you would have ended up having to reduce the chances of having to bear the liability. Choosing a limited liability partnership or operating as an LLP. So most firms have actually started adapting this, operating as an LLP. Obtaining professional indemnity insurance, whereby you get an insurance cover that is actually able to protect you for any liability arising out of your audit work or your work as an auditor. If it arises, the insurance company actually pays. The insurance company will likely end up having to pay. So obtaining professional indemnity insurance cover. So these are some of the ways as to how you can actually end up having to do what? Reduce on your audit liability, reduce on your audit liability. Reduce on your audit liability. So that is the end of this topic. That is the end of this topic we call the regulatory framework, audit framework and regulations, audit framework and regulations, audit framework and regulations. Topic number 2, audit framework and regulations, audit framework and regulations. So I don't know if there's any question up to there. I don't know if there's any question up to there. I don't know if there's any question up to there. Mwangi Gitonga, do you have any question? Lamek Odiambo, do you have a question? Mangi Itonga says, no, thank you. No, thank you. So I can see Purity is asking, we deal with questions later. So we'll do some questions, but probably maybe in the next class before we start the next topic, which is actually professional and ethical considerations. Topic number 3, professional and ethical considerations. We'll be able to look at some past paper questions. But you know, the questions for advanced auditing are usually intertwined. They can be having a question that is touching on several topics. So probably by the time we reach around topic, maybe after topic 3, is when we start covering a lot of questions, because the questions are usually intertwined to several concepts touching on auditing and assurance. The question could be touching on engagement. How do you, an auditor is actually engaged? The same question is actually touching on audit risk. The same question is actually basically touching on money laundering. So they're usually intertwined. So, but we'll be able to look at some questions from before we start the next class. We'll be able to look at some questions, past paper questions. So they're usually case questions that basically touch on several areas. There can be one question whereby you are given a scenario, you are sent out as an auditor, there's an issue about money laundering arising, there's an issue about audit engagement arising out of the same question. So you need to be able to find a way as to how you can be able to answer all of them together. So we look at some questions before we start our class on Friday. Before we start our class on Friday, we look at some past paper questions. But you don't have to worry. We'll do a lot of questions. We'll do a lot of questions when the time really comes. We'll be able to do. For example, we'll cover the syllabus and just spare some lessons for just revision, pure revision. So those who have been in this particular class, they actually know. So there'll be intensive revision before the exam, prepare for the exam. But during these lessons, of course, you'll be looking at some past paper questions, 1 or 2 or 3, before we move to the next topic like that. After that, intensive revision of past paper questions. So I think we'll be sharing all the videos. Get used to using videos to revise these particular units. Listen a lot to what the teacher is actually saying. You'll be able to grasp a lot. Don't stick to just reading the notes. Don't just stick to reading the notes. Listen to what the teacher is basically trying to explain. You'll be able to remember a lot. You remember a lot what the teacher was saying when he was explaining this particular matter. How did he actually explain it? Because in this case, as to how they set advanced auditing and assurance, the approach is very different from that other auditing and the intermediate. So here is like now you are assumed to be like an auditor. It is more of practical. So if you're actually able to like listen to how the explanations are actually made, then when you read the notes, it becomes a bit easy. It's not a matter of having to cram, read the notes and actually cram. You need to understand. You need to understand, for example, now in this case, when the teacher talks about insider dealing, how can it happen? Because they can bring a scenario about insider dealing. Then they ask you, what was the responsibility of the auditor in this case? You need to be able to realize maybe this is insider dealing. So the auditor is not actually allowed to be involved in insider dealing. It is a criminal liability, like that. So we'll be sharing the videos. So you'll be making reference to them as you try to revise from time to time. Make reference to them as you try to revise from time to time. Don't have the tendency of just having to look at the notes and read by yourself. Things might become a bit difficult for you. They might become a bit difficult for you. But of course, if you listen to how the teacher is trying to explain, you'll be able to remember several things. Even in the exam room, what the teacher was saying is what you're going to write. But if you try to cram, it's not now just cramming points, but how you can be able to explain them or actually express yourself, it becomes a bit difficult, because this particular paper is actually all about having to be able to express yourself. You have been given a scenario, you need to be able to express yourself like an auditor. Express yourself like an auditor, what is supposed to happen there. So if you can be able to express yourself, then it simply means that you'll have something to write in the answer sheet. in the answer sheet. So we can end there for today. I wish all of you enjoy the rest of your evening. So let's meet on Friday. On Friday, same time. Thank you very much for having joined this particular session.